So, profit margins sound simple, but I bet they're trickier than they look. What's the big idea?
A profit margin is just what fraction of each revenue dollar you keep at a specific stage. It's your profit divided by revenue, shown as a percentage. That's the whole foundation.
Got it. But why do we need 4 different margins? Isn't one enough to tell if a company's profitable?
Because each margin tells you a different story. Gross margin shows production efficiency. Operating margin adds overhead. Net margin includes interest and taxes. EBITDA strips out accounting choices. They're like layers of an onion.
Walk me through the waterfall. How do they connect from top to bottom on an income statement?
Start with revenue. Subtract cost of goods sold to get gross profit, that's gross margin. Then subtract operating expenses like salaries and rent to get operating profit, operating margin. Then subtract interest and taxes for net profit, net margin. EBITDA is operating profit before depreciation and amortization.
So EBITDA is basically operating profit with some non-cash stuff added back? Why would anyone do that?
Exactly. EBITDA adds back depreciation and amortization because those are accounting charges, not actual cash leaving the door. It helps compare companies with different equipment or acquisition histories. But it can flatter a cash-hungry business, so use it carefully.
Give me a real example, like 2 companies with the same revenue but totally different margins.
Imagine 2 $1 billion revenue firms. A software company might have 80% gross margin and 30% net margin. A grocery store might have 20% gross margin and 2% net margin. Same revenue, but the software firm keeps $300 million, the grocer keeps $20 million. Completely different economics.
Wow. So what's a good margin? Is there a magic number I should look for?
No magic number, it depends on industry. Software and pharma often have high gross margins, 70 to 90%. Retail and airlines are low, 20 to 40%. Compare a company to its direct peers, not to a random tech stock. A 10% net margin is great for a retailer but terrible for a software firm.
Now, what are the 5 pitfalls that trip up beginners when they first analyze margins?
1. Comparing across industries. 2. Ignoring one-time charges or gains that distort net margin. 3. Using EBITDA as cash flow, it's not. 4. Forgetting that revenue growth can hide falling margins. 5. Not checking if margins are trending up or down over several years, not just one snapshot.
Can you give me a quick example of a pitfall in action, like a company that looks great but isn't?
Sure. A company reports 20% net margin, but that includes a one-time land sale. Strip that out, and its real net margin is 5%. If you don't read the footnotes, you'd think it's a stellar business when it's actually struggling. Always check for non-recurring items.
So how do I actually use these margins to compare 2 companies in the same industry?
Pull their income statements. Calculate all 4 margins for each. Then compare them side by side. If company A has higher gross margin but lower operating margin, it spends more on overhead. If company B has higher net margin, it manages taxes or interest better. That tells you where each wins or loses.
What's the single most important margin for a beginner to focus on first?
Start with gross margin. It's the most stable and tells you about the core product's pricing power. If gross margin is weak, nothing downstream can save it. Then look at operating margin to see if management controls costs. Net margin is last because it's noisy.
Final question, what's your one actionable piece of advice for a beginner investor today?
Before you buy any stock, write down its gross, operating, net, and EBITDA margins for the last 5 years. If they're stable or improving, that's a good sign. If they're falling, dig into why. This one habit will save you from many bad investments.